big part of my thesis for a while is that this is much more like the 1940s. And that's because if you look back at the sources of money creation, in the 1970s, you had peak demographics. You had the baby boomer generation reaching their home buying years. And so you had basically a lot of bank lending driven inflation. A lot of loans were being created. So you had an expansion of broad money, largely from that bank lending channel. The challenge now is that we have kind of 1940 style inflation. Right now, they're treating it as though it's 1970s inflation. So they're treating it as though, you have to quell bank lending by raising interest rates, which I think is going to be a challenge.
Lyn Alden, a well-known macro analyst and investment strategist, offered her opinion on the likelihood of a generalized financial crisis in the wake of Silicon Valley Bank's failure. Alden spoke about the negative effects of the U.S. Federal Reserve's actions in the commercial and public sectors during a recent interview with well-known YouTuber Benjamin Cowan. According to the well-known financial analyst, the Apex Bank has been fighting inflation with the wrong instruments, and as a result, we are now starting to see the results of that. Alden also commented on how the central bank has been transferring liquidity from small banks towards large banks.
I think energy and commodity shortages are going to probably be a multi-year story to deal with. They come and go in terms of their severity based on weather, based on demand destruction temporarily, but the supply side remains rather tight. So I think that's an ongoing kind of constraint to be aware of. And on the other side of that, on the demand side, we have, over the past couple of decades, we transferred a lot of debt from the private sector to the public sector. Basically, whenever there's a crisis, we kind of push some of that debt up to the sovereign level. And now a lot of it's actually becoming a pretty relevant size up there. You have a lot of countries throughout the developed world that have over 100% debt to GDP. And that was, that worked for a while when you had structurally declining interest rates, because even though you had higher debt to GDP, you didn't really have higher interest servicing costs, because there was offset by that structural downtrend in interest rates. And now that we're in a flat to up interest rate environment, while you still have very large deficits, while you still have very high sovereign debt to GDPs, you start to get an actual problem with interest expense. And so you can get a situation, if the central banks are not careful, where as they try to raise rates to quell private sector inflation, they risk exacerbating public sector driven inflation, and they can generate this kind of sticky runaway type of inflation environment, especially when you have those commodity and supply backdrops. So I think the key risk is that we're probably going to have a number of false dawns where it looks like we're getting inflation under control, but then it's still, the underlying factors are still there when we try to have another growth cycle. And along the way, whenever they try to tighten their currencies up, most assets then suffer in price. So a big part of my thesis for a while is that this is much more like the 1940s. And that's because if you look back at the sources of money creation, in the 1970s, you had peak demographics. You had the baby boomer generation reaching their home buying years. And so you had basically a lot of bank lending driven inflation. A lot of loans were being created. So you had an expansion of broad money, largely from that bank lending channel. And then, adding on to that, you had, deficits from the war, deficits from, kind of domestic programs, but they were actually a smaller component compared to that bank lending. Whereas in the 1940s, you had the opposite. You didn't really have banks lending much at all, but you had absolutely massive fiscal deficits and monetization of those deficits in order to fund World War II. But a lot of that was domestic. You were spending on factories, you were spending it on labor. When the soldiers came home, you gave them GI bills to go get trained and educated and get a house, that kind of thing. So that was basically a massive fiscal spending program, and that's what drove up a lot of that inflation. And the challenge now is that we have kind of 1940 style inflation. Right now, they're treating it as though it's 1970s inflation. So they're treating it as though, you have to quell bank lending by raising interest rates, which I think is going to be a challenge. And then two, in the 1940s, you had an end to it. You had basically, when the war ended, you had a productivity boom. They were able to get that under control. Whereas now, when you look at deficits for the foreseeable future, and a lot of these are non-discretionary types of spending throughout the developed world, it's mostly, taking care of promises that were made decades ago. There's really not any clean solution for how you would stop this sort of fiscal-driven inflation. And I think that's one of the big challenges facing them. Now, obviously, the one similarity we have to the 70s is the energy side. And so a kind of a a not widely reported fact about the 70s is that U.S. oil production peaked in 1970. So basically from the middle late 1800s all the way up to 1970, you had structurally rising almost every year, but structurally rising U.S. oil production, and that peaked. We basically maxed out how much conventional oil we could get per year out of the United States. And so we had that kind of downtrend at the same time as we had all that demand from all that home building, all that economic growth. And so we became far more reliant on export, which obviously gave us conflicts in the Middle East regarding oil embargoes and things like that. So you had that supply side in oil, while you also had that demand side. And I think today we have somewhat similar dynamics where throughout the 2010s, we most marginal oil production growth came from shale oil. That's I think the low-hanging fruit has already been gotten from that. Doesn't mean we can't go a little higher, but I think that we're not going to see a straight line upward of U.S. oil production like we saw in the past decade, and that means there's not a lot of new marginal supply out there at a time when we also have this fiscal-driven inflation. So I think that's the one thing where it is kind of similar to the 70s, is that oil constraint. We're doing the weird combination where we're fighting 1940 style inflation with 1970s policy, and so that particular mix is kind of unprecedented. My base case since around the spring of 2022 is that we'll tighten into a disinflationary recession, and then when they try to ease out of that is when we would get the second round of inflation, perhaps in 2024, perhaps in 2025, depends on the timing. Obviously, those things can play out quicker or shorter than you expect. And for so far, I would say that's played out because since then we've seen the Purchasing Managers Index, for example, decline from 55 down to 47, which is mildly contraction. We've seen deceleration in most economic indicators, with the labor market still being kind of the pretty strong area. But you generally see a broad deceleration of growth, kind of a stall speed in terms of growth. If you look at capital orders, if you look at retail spending, if you look at a lot of these nominal figures and you adjust them for inflation, we're generally flat to down year over year in real terms in a lot of these metrics. Same thing for like imports. And so right now I would describe this as being at stall speed. Basically, the tight monetary policy has reined in activity specifically in the real estate sector and the unprofitable tech sector. Those are the two most interest rate sensitive areas. Other areas have held up better. And so my base case continues to be deceleration into recession, and then inflation and basically a period of renewed growth and inflation on the other side of it. The risk factor that I'm watching for that view is that it's possible that the fiscal-driven inflation is enough to override the private sector disinflation from this tightening of policy sooner than that, right? And so I think we saw a taste of that in December and January. We basically saw a mild reacceleration of some of the economic growth and inflation factors. But like we saw today, for example, and I actually wrote about this to clients a while ago, that upon seeing that, what Powell's going to do is get more hawkish. He's going to, he sees that kind of volley. He's like holding a volleyball underwater. He sees it kind of coming back out, and he's going to push it back down. And what we saw from his talk today is he's doing exactly that. We just saw a rapid repricing of the probability that they're going to do 50 basis points instead of 25 basis points. And so I still lean towards that disinflation into recession, followed by next round of growth and inflation outlook. But we do have to be mindful that they might not even be able to fully constrain it, and that it just kind of breaks out sooner than we think. But I think that's still the minority view, but one that I continue to look for indicators that is happening.
Regarding Lyn Alden's interview, what are your thoughts? In the section below, please share your thoughts and views. Additionally, be sure to turn on post alerts, subscribe to the channel, and like the video if you enjoyed it so you won't miss any of our upcoming updates on the SVB collapse. Many thanks for taking the time to watch our videos.